12% off its peak from October 2007. However, concerns about rising oil prices, the end of the Fed's easy money policy, all these things have everybody worried. So do you ride the bull or not? That's the big question right now. Joining us, Tim Hayes, Ned Davis Research, and Rady, CEO of Rady Asset Management. Great to have both of you with us, and I appreciate it. Tim, you've written a report which I think accurately summarizes where you stand. You didn't mince words. You're bullish. You've got 11 things you're looking at, and 10 of them are saying bull, bull, bull.
Well, that's right. There's really a lot to like right now in terms of the stock market environment. While we're seeing a moderation of economic growth, we saw positive numbers today. But this is toward a trend growth rate in terms of the economy. In fact, we have a model that on a scale of 0 to 100 is 93% favorable toward economic growth. And then we have a similar earnings model, which is at 100%. So the economic and earnings environment is conducive to a continued uptrend.
Even with oil, even with the Fed at least stopping buying treasuries, never mind selling them and potentially raising rates on top of that?
Well, right now, actually, an interesting statistic is to look at the oil price and also the 10-year Treasury bond yield relative to the stock market. And right now we have a pretty substantial positive correlation, and what that tells us is that interest rates have not gotten to the point where they've really become a significant negative impact on stock prices, and the same thing with the oil price. We would be more concerned if oil would get up to, say, 33% on a year-to-year change basis, and if the bond yield would get up in that 4 to 5% area.
All right, so we're not far from that, but not there yet either. Harry, what about you? Are you across the board as optimistic or a bit more hedged?
We're much more cautious, and we're tactical long short manager, and we're contrarians. So when investors tend to get more positive, like your other guest, we tend to get more cautious. So we think that there are many factors that justify an upward trending stock market, but there are enormous geopolitical risks: the Middle East, Japan, the budget deficit, oil, et cetera, et cetera, et cetera. So we would not be wholesalely bullish. We, as a long-short manager, we have recently increased our short exposure, and we are looking to protect the downside while not giving up on the potential for upside.
Okay, so let's talk about what you would do. One thing I thought interesting in your notes, Harry, you're saying deals take 6 months to a year and a half to get done, and you think the pipeline is full, which means, well, a whole lot of things are going to get announced and a whole lot of stocks are going to surge, right?
Yeah, we think that M&A, while people are talking about it, we don't think that the market and most investors grasp how full the pipeline is for M&A. We think there's going to be an absolute explosion of M&A. And the rationale for that is that companies have done a very good job of paying down debt, and there's an enormous amount of cash sitting on balance sheet.
Right.
In addition to that, the uncertainty of the economy and the growth and the multiples that many of these companies are trading at. The only way they're going to be able to justify those multiples is growth via acquisition.
And how do you play that as an investor? You've got a way?
Yeah, well, one way is we want to own the shipping-related stocks, and we own a company called Aegean Marine. The ticker is ANW. The stock's down from the mid-30s to around 8.5, trading at a conservative 80% discount to compressed NAV. There are a number of analysts that have target prices anywhere from $12 to $20, and we'd be on the high end of that. So we think that it's easily a double or a triple. We also like Akamai. Akamai is a play on the secular trend of video and mobile video, and the stock's down 30–40%, and we think that that's an absolute home run opportunity. Back up the truck.
All right, I like that. Quickly before we go, Tim, best idea right now?
I'd say stay long right now. In fact, use this pullback as an opportunity to add to exposure. We'd recommend being 10% overweight your benchmark.
Okay, well, thanks very much. We appreciate it. Tim, Harry, have a great weekend.
Thank you, you too.
And in a week when an American IPO surged 56%